G'day there, ladies and gents of the internet. Mark Wallace here from Econisis. Hope you're all doing well. It is the third week of November 2023, and today we're going to be talking about the most recent Reserve Bank interest rate increase on the last week, which at the time of this recording, which of course was the Melbourne Cup public holiday in Melbourne, or the Melbourne Cup Day. We saw the Reserve Bank increase interest rates in response to continued sticky and high inflationary pressures within the country. The problem that we're starting to see, and that hasn't been recognised so far by the Reserve Bank, we have a new governor. Unfortunately, nothing has changed. If anything, the vitriol coming out of the Reserve Bank has become even more intense. What we're actually starting to see is a breakdown of monetary policy effectiveness because of the increasing positive correlation that exists between interest rate increases and that of expenditure by the largest generation, that of the baby boomers. So there was some work a few months ago by the Commonwealth Bank that showed that the baby boomers have actually increased their expenditure profile since interest rates have increased and not decreased it like they have all other sectors as of the household sector of the economy. This is because of the way in which disposable income is impacted by interest rates for the vast majority of households is no longer applying to that of the boomers as they move out of their mortgage-focused part of their household life cycle, and so therefore their relationship with interest rates has changed. At first, a few years ago, it was moving into more of a neutral position where interest rate increases didn't really have a fundamental impact up or down as to what their expenditure profile was, so they were generally neutral. Now it's got to the point where every time the interest rate goes up, boomers are getting more money, not less, in terms of disposable income. Because the way in which interest rates and monetary policy is designed to work is that it increases the largest cost for most households, being that of their mortgage, decreases their disposable income, which decreases the amount of money in the economy that's potentially driving up or competing for the same goods and services, and driving up prices. However, in the case of boomers, there's two real impacts in which they're actually starting to increase interest rates is actually starting to drive inflation rather than address inflation. The first is, as I mentioned, that boomers have moved away from earning an income and having a mortgage and are now actually earning money off their accumulated wealth through interest returns. So when the interest rate goes up, they actually get a bigger return on their investment and are actually spending more money. When you add that to the fact that the boomer generation has the highest propensity of consumer spending of any generation, then the problem is any extra money that goes through it is going to have a disproportionately large impact on the demand on the households, coupled with the fact that it is the largest sector still, the largest segment of the household sector still, means that they're having a disproportionately large impact on inflationary pressures. So increasing interest rates actually helps boomers drive inflation even more. The second one, or the area where notionally interest rates should be impacting, is on investment properties. As I've said before, 80% of all investment properties are owned by people over the age of 65. There is a significant hyper-concentration of home ownership and housing ownership in this country, and the boomers are obviously holding the vast majority of that, far disproportionate to their share of the population, even adjusted for their age and position in the housing life cycle. Now, traditionally, that would see those, if it was a household sector, if it was a house and a house budget, that would have a flow-on effect to disposable income. But because it's an investment, what we're seeing is that those increases in housing mortgage servicing costs for investment properties owned by boomers are being passed on to renters in the form of rental increases. And in the most recent statement by the RBA, rent price increases was identified as one of the big drivers of inflation going forward into the next 12 months that may necessitate increased interest rates. So as a result of this, we're in a really weird, unusual, and potentially devastating position for the vast majority of households in this country, where the largest generation, the older generation, has now decoupled from the rest of the country and the rest of the households when it comes to the economic well-being of this country. And that interest rate increases are actually resulting in that generation making things much, much worse. Now, we shouldn't be surprised. That's a behavioral trend we've seen for many years now, but it is now starting to occur at a rate where it is effectively not only making monetary policy difficult to implement, but actually resulting in monetary policy making things worse. So until the Reserve Bank realizes this and realizes that even if they plunge the rest of the economy into recession, it's still not going to drive down the inflationary pressures caused by boomers, then we're not going to be in a position to be able to respond to inflation. Unfortunately, Where this actually vests now in terms of responsibility is with the government, because what it has shown is that there are fundamental misalignments between one generation and everybody else in the economy, and that regulatory change is required in order to ensure that a more aligned, rational decision is being made by boomer households in response to tightening monetary policy. The problem with that, and the problem we've had so far with the current government, as far superior as they are economically to the previous government, and far less, intentionally malevolent than the previous government, is the fact that they're also positioned themselves as a centrist government, and centrist governments, by definition, don't do anything. We need a much greater level of intervention from the government to a wholesale change of the socioeconomic structures of the boomer generation in order to realign them with the best interests of everybody else. Because it has now reached the point where it is everybody versus the boomers. And because of the hyper-concentration of wealth, and because of this positive correlation with monetary policy, and the Reserve Bank's almost complicit approach to enriching the boomer generation at the expense of everybody else, we're now in a position where monetary policy is no longer effective, and in fact is making things much, much worse. And I've talked about some of the reforms in the past around home ownership, around wealth distribution, around taxes, around treatments of things like negative gearing and social security in this country, and that needs to change in order to see the drastic level of wealth redistribution that we need to away from the boomers to everybody else to maintain the sustainability of our economic system. So I won't touch on those in details, but we need those reforms pretty desperately now, because if monetary policy is no longer effective and in fact is making things worse, then it falls to fiscal policy and fiscal solutions from the government to fix the problem. And that is what we're now requiring. Unfortunately, I suspect in the short to medium term, the Reserve Bank will continue to go down their neoclassical traditional economic approach, because they can't come to terms with the fact that they're no longer helpful, relevant, or in fact operating positively on behalf of the people within this country in the long term. And that's going to be a really big culture shock for them to come to terms with, and they're not going to for quite a while, until basically everything falls over. And that's the fear, is that the Reserve Bank is actually now the biggest problem within this country, because of their enabling role of the boomers. But that is it for today, ladies and gentlemen. Really interesting topic, a really interesting dynamic. So every time you see interest rates increases, just remember, we just made a lot of boomers a lot richer as a result. But that's it for today. Thank you so much. Have a great one. Talk to you soon.